You've got a column out where you take a look at what the Fed's likely to do and what you think they should be doing, and it's not one and the same right now. What do you think the concerns are about the Fed's policy?
I think the concern is that the Fed will remain ultra dovish because the short-term outlook has become dimmer, even though the longer-term outlook has become brighter. So a classic central bank that is concerned about the lags in the impact of its policies would be looking forward and would be starting to signal a tapering. But this Fed is not going to do that. This Fed would remain pedal to the metal for as long as it can, at the risk of creating more financial bubbles.
If the Fed were to indicate that it might, at some time, in the not-too-distant future, start thinking about potentially tapering, I would imagine there'd be a taper tantrum from the markets, and the markets might drop as quickly as they've risen.
Yes, it's a classic parenting problem. Take away the candy, and you'll get a tantrum. But keep on supplying candy, it doesn't make the things any easier. That's why I've been on this issue for a few years now, Becky, because it's pretty clear that if you continue ample and predictable liquidity injections, that's all the market is going to care about. And in the process, you're going to decouple from the fundamentals. And at some point, you've got to really hope that the fundamentals can improve fast enough to validate the marketplace. Otherwise, you will have a big tantrum, as you point out.
As you mentioned, you think that there are bubbles forming all over the place. You want to point to a few of them?
Oh, they're all over. You just talked about SPACs, and you heard that. Look at what AMC has been able to raise, $1 billion of capital at a time when its outlook is pretty grim because of what's going on. I can point to segment after segment where there's enormous froth, but for good reason. Remember this notion of a rational bubble. It is bubblish, but it's rational because there's so much liquidity sloshing around into the system that it just keeps on pushing up asset prices over and over again.
You know, we heard a very similar theme from Lloyd Blankfein just now, and we've heard it from a lot of the smart investors we talked to, Mohammed. You've been echoing this for a while. Things look bubbly, but it looks like there's no alternative but to continue to put money in stocks and in some of these areas. Is that kind of what you think, too? Like, even though you know there's potential for a bad outcome, you don't know when that's going to be.
Yeah, you've heard me for now say over and over again that the path of least resistance for the risk markets is higher. It doesn't mean that you shouldn't worry about fundamentals. You just have to respect the technicals. But you have to do so with a tactical mindset. It's really important to have a tactical mindset, understanding that that's one massive liquidity wave, and it can break. So keep that in your mind. Be careful about how much liquidity you're giving up. Be careful about how far you venture from your natural habitat, because these things can turn around. But for now, you've heard me say this over and over again. When I look at all the reasons how this liquidity bubble can break, they're all flashing yellow, but none are flashing red. So I really understand why the path of least resistance will be higher. But look at today. The market can't figure out today whether the bad news over the weekend and this morning is good news or bad news for markets. We know it's bad news for fundamentals, but is it good news or bad news for markets? That's what the markets are trying to decide this morning.
Shepard Smith here. Thanks for watching CNBC on YouTube.